Welcome back to Financial Clarity for Doctors, everyone. This is Rachelle Vanderzanden here with Corey Janoff.
I'm here too.
Yep, financial advisors. We've been doing this a long time. And today we just wanted to take a moment to complain about taxes with all of you because no one likes taxes. Let's be real here. We're not accountants, so it's not about like providing tax advice or anything like that, but just covering some basics on taxes and how to potentially reduce your taxable income, maybe make the process of working on taxes a little bit easier potentially. There's not necessarily a whole lot you can do. Things are complicated here. If you make a lot of money, you probably pay a little taxes. It's just that time of year where everyone has a little extra angst about it because we're trying to work on filing our returns. But realistically, most of us pay taxes all year long. It's just our paychecks are smaller every year, every month, every paycheck because we pay some to the government for public goods and services. So we're gonna just cover some basics, talk about why it sucks, and then maybe talk a little bit about what you could do about it.
Yeah, taxes. And our
Woo!
American tax system, in my opinion, seems overly complicated. Like
It
there's different
is.
rules based on your income, what year you were born, what type of accounts you have, et cetera, et cetera. And
Mm-hmm.
like, you know, from our end, it's even more tricky because, like, again, depending on your age, there's different RMD rules for retirement accounts. There's different, credits based on income, different qualifications. So it makes it fun, keeps us on our toes.
Yeah. If you
Um,
have a kid's brokerage account, it's different than having a grown-up brokerage
mhm.
account. Like,
If you have an inherited IRA, it's different
yeah,
than your IRA. And if the inherited IRA was from someone who died before 2020, the rules are different than if they died after
it's
2019.
wild. Yep.
RMDs are different, depending on what year you were born. So,
Yep.
and it's going to keep changing and evolving as time goes on. So, but anyways, so taxes, what are they? You pay money into a pool that's used for public goods and services. Pretty straightforward. I think most people can get behind that. We like roads to drive on, bridges that work, police officers to protect us, firefighters, etc. Um, but lots of people might disagree on how much is appropriate, how it should be allocated. We're not here to debate that. We're just here to, talk from an objective standpoint on, what they are, what you can do to try and optimize your circumstances from a tax and financial perspective. So we got different types of taxes. Your federal taxes, those go towards things like defense, federal agencies, social safety nets like Medicare, Medicaid, Social Security. Those are the biggest components of our tax system. State taxes, more for like schools, state pensions, public safety, social services, some Medicaid funding, roads, bridges, etc. Then there's the local, which are, a lot of that's property taxes. You get the every time we have those ballot measures for, oh, we're going to pass a bond to upgrade this school or do this thing to the water treatment facility. Um, levies for these various things, fire safety, schools, local services. Like Portland, for example, has free preschool if you're in the specific area. And then there's going to be some overlap between the three of those. Some federal funds get trickled down to the state and local areas. Um, but every single state municipality needs tax revenue. So even if you're in a state with no income tax, it's not like they're just better at balancing the budget than a state with high income tax. They need to operate somehow. So that's going to be via potentially higher property taxes, sales taxes, excise taxes, you name it. There's going to be taxes one way or another. Um, and that's how they generate their revenue to pay for all those goods and services that every state needs, or most states need to provide.
Mm-hmm. Yeah, I mean, I think every state has some services they have to provide. It's really weird, like how our government is set up with like the federal and the state system, because you have just things that are split up between those two. But the federal government doesn't do everything that we assume the government does. A lot of it is responsible, or like the state's responsible for it, and they have to take care of a lot of that stuff. So, you're going to pay taxes everywhere you go, which makes sense, right? If you make money, you're going to pay taxes. And if it's just a part of everyday life, it's kind of like, well, why does it suck so much? Well, no one wants to give up part of their paycheck. Like we'd rather have more money in our own pockets to a certain extent. I think the other thing is that as you earn more, you pay more in taxes, and that doesn't necessarily feel fun. Like no one likes to look and be like, oh, half of my paycheck is gone at this point, whether it's going to, state income taxes, federal income taxes, Social Security and Medicare, your 401k contributions. Like you got to tell yourself that's for me too, just later, but still, like half your paycheck is gone to a certain extent. All else being equal, the more money you make, the more taxes you'll pay, but you'll pocket more after taxes than someone who's earning less. Like our tax system is not set up so that, if you make more money, you're gonna like make less money because you paid so much in taxes. That's not actually how it works. So don't complain to your friends who make less money than you because you're paying more taxes to them. You still have more money in your pocket than that person does. It's kind of interesting. I feel like when you're a W-2 employee, it's kind of like, you get what you get in your bank account, and you're like, this is what it is. This is what I'm living on. And you don't necessarily pay a ton of attention to how much is being withdrawn, although we do have some clients are pretty fixated on it, honestly. But when you're self-employed, it's much more visible. Like you see every dollar because you get all of your income. You have to make the tax payments and things like that. So that visibility can make it a little bit more painful for folks, just knowing like I have to write a $20,000 check this quarter to pay my quarterly taxes or whatever it is. Like that can feel really painful. And I think that those people are pretty proactive generally about trying to reduce their taxable income and make sure that they're paying as little in taxes as possible. I think
It's
the other
it's a
thing
lot more
that,
painful when you have to write the check
yeah,
or like set up
or
the auto
schedule the
debit.
deposit online. Yeah.
Yeah, versus the government just takes it out of your paycheck and you true up in April.
Yeah,
Yeah,
for sure. I think so anyway. Obviously, that's all mental. Like you're paying the same amount of taxes, more or less, but still, it's harder to just see it come in and then watch it go out.
there's a reason for most employees, they take it from your paycheck before you get your paycheck versus asking you to pay them later
Hmm.
because they're not stupid. They know that they'll collect a higher percentage of what they're owed if they take it up front before you get a chance to spend it.
Yeah, and have your employer be required to help with that instead of individual employees, which are more likely to maybe not do it correctly. But yeah, I think the other part that makes taxes so painful, especially this time of year, is what Corey was talking about earlier. But the tax system is very, very complicated in this country. There's like this component of fear, like when you're working on your tax return, like, hey, I'm doing my best here to file my taxes correctly. But what if I mess up? Like not even intentionally avoiding taxes, but I just miss something. I don't file it correctly, and then I get audited, and it's going to be terrible. And they're going to put me in jail. Like realistically, no one's probably going to put you in jail. Again, we don't know that for sure, but it's pretty unlikely that that would happen. But if that's kind of where you're at when you're filing your taxes, it's probably time for an accountant. Like even if you can do your taxes on your own, if it's worth it to delegate that and kind of offload that mental burden and let someone else take care of it for you, like do it. Like just give it to someone else so they can worry about it. Like, obviously, you still have to do a lot of the work. You still have to gather the documents. You still have to provide them with everything. And so you're doing probably 50% of the work anyway. But it's going to be much less mentally stressful for you if you're a person who has some angst about that. Yeah.
For sure. Yeah, delegate. I'm a big fan of delegating things that don't bring you joy in life,
Hmm.
whether that's doing your taxes, cleaning your toilets, mowing your lawn, whatever you're not into. getting groceries delivered if you don't want to go to Costco on a Sunday and wait in those lines. Um, but let's see. So, yeah, we have a tricky tax code. There's the fear of messing up, which,
Hmm.
yeah, other countries, a lot of countries, it's the reverse. The government does the taxes for them and says, here's your refund. Here's what you owe. If you feel like we're wrong, then you can audit us. But it's not
Yeah.
this way where we got to figure it out ourselves. And then the government tells us, we think you messed up. Try again.
Yeah.
So,
And in a lot of those countries, it's just because the tax system is so much less complicated. It's just like, like this is the percentage everyone pays. That's very easy to calculate. Moving on. And maybe if you're lower income, you might be able to apply for some additional social services and things like that, but it's kind of separate from the tax system. Like taxes are what they are. And you don't like there's not a complicated return to file with like itemized deductions and like your this portion of your income is taxed at this percent and this percent is over here and like all that kind of stuff. It just the simpler system allows them to do it more automatically so you don't have to worry about all the work that goes into it.
yeah, or a country that's run and the rules are created by lawyers. So earmuffs for any lawyers listening here. But like there's a lot of negotiating and haggling, and we'll make exceptions for this group and we'll penalize that
Hmm.
group. And we're going to create all these different scenarios for all these hypothetical circumstances. And for some people, if depending on your circumstances, there are a lot of opportunities to take advantage of the tax code legally, and it incentivizes you to, do certain things. Like there's a lot of incentives for business owners, entrepreneurs, self-employed individuals. We'll talk about this in a minute, but you can write off a lot more. You can save a lot more for retirement in a tax favorable manner. So they incentivize people to take those risks and go out on your own, you know, underlying risk because you're not
Hmm.
guaranteed to come out better than if you just took the job where they pay you to show up and then you can go home and that's it. You don't have to worry about anything else. But if you want to go run the business, take the risk, you get in theory unlimited upside in America, but there's also a lot of downside and maybe less safety nets than other countries. But the tax code, encourages folks to try and pursue those avenues. So,
Hmm.
anyways, what can we do to make our lives easier, optimize things from a tax and financial standpoint? Um, we already talked about if you're a high income earner, probably worth delegating. I mean, I guess if you're just salaried, you don't have anything else going on, maybe you're making $1 million a year as a W-2 employee in a hospital and you got one paycheck, one W-2, you own your house, don't have any investment properties, don't have any business interests. It's very simple, straightforward, then sure, TurboTax could be the way to go. But, generally speaking, the more you move up the income ladder, the more complicated things tend to get. And it just might not even be worth your time. Like if you're making $1 million a year, that's $500 an hour based on a 2,000 hour work year. Like if you're spending more than an hour or two trying to figure out your taxes every year, like you're better off just working an extra hour and paying an accountant to do it for you. Um, so is it even worth your time at that point? But
Hmm.
but that's personal decision there. I think organization is key. Track things, expenses, contributions, charitable contributions. Um,
Childcare costs
yeah,
potentially.
childcare,
Hmm.
work-related expenses, especially if you're self-employed, you got to, track everything and hopefully you have some software record keeping for that. Retirement is a big one as well. And then, make it nice and tidy and clean and communicate clearly to your tax preparer. Here's what I did during the year. Here's all the documentation that you need, and that'll make their job easier, more efficient, and hopefully keep your preparation costs as low as possible. Um, taxes, by the time this gets published, probably late February, if I had to guess, beginning of March. hopefully by that point, everyone will have all of their required tax documents available. The last ones are usually those taxable investment accounts um, that often don't get sent out until end of February, beginning of March. And then if you own part of a business, like if you're a partner in your practice, your K1 might be delayed and they might not get that to you until a little later. So that's always an annoying little holdup. Um, but yeah, for most folks by um, February, beginning of March, you should have everything you need to file your taxes and be able to get that all done on time. But
Yep.
yeah, keep things organized, keep your folders labeled, spreadsheets, etc. to so you don't have to go digging through boxes of receipts to try and figure things out.
Yep. That's just the process. I think that when we're talking about like taxable income in general and things like that and trying to reduce your taxable income, probably the biggest thing that you can do is saving into any pre-tax retirement vehicles. So if you're one of those folks that's really concerned about how much you're paying in income taxes, like that's going to be the biggest thing you can do. Like if you're a W-2 employee, you can put up to 24,500 potentially into a 401k or a 403b if your employer offers that. And that's all money that doesn't get taxed this year. Instead, it can be invested and it can grow. And then when you take it out, you'll pay taxes on it then. Most people will probably live on less income in retirement than they're making while they're working. So it's possible that you'll be in a lower tax bracket at that time. And that's part of the argument for doing that. Like we don't know exactly what the tax brackets will be when you're retired. So that's a big mystery. But it can be very helpful for reducing your taxable income now. And then, if you're self-employed, you can potentially make an employee contributions and also like an employer contribution. You can set up like a cash balance or like pension type of plan, set aside a lot of money pre-tax that way. So there's lots of different things that you can do to potentially reduce your taxable income when you're self-employed. You can also potentially do things like put your kids on payroll, like, sign them up to model on your website and pay them some money. And like, then that payroll reduces your taxable income. You can put it in a Roth IRA for them. Like, there's all sorts of things that you can potentially do. But it's not as easy when you're a W-2 employee, or there's just not as much opportunity for reducing your taxable income. So those pre-tax retirement plans are more important. They're just smaller. That 24,500 is the most. And
The
then,
employer, though, depending on where you're working, they might
yeah.
have more than one. So, if you're at a hospital, you might have a
Mhm.
403b. You might also have a 401a that you put money into. There might also be an optional 457b that you could put another
Yeah.
24,500 into. If you're at a place with a 401k, maybe they also have a cash balance plan that you can participate in, or a deferred compensation plan that you can put some of your earnings into. So there might be multiple plans available to you, but it's subject to whatever the employer decides they want to offer. And, another perk of working for someone else is they might contribute some money on your behalf to the retirement plan. So, hey, here's this retirement plan. We're going to match you dollar for dollar up to 4% of your pay. All right, if you're making a few $100,000, there's a $12,000 uh, contribution right there just for showing up to work. Um, they might also do some additional profit sharing to your plan. So they're like, I have some docs that are private practices, and there's a couple hospitals out there that actually more or less max fund the plan. They put the full this year, the limit will be 72,000 into it. Now, those are fewer and farther between, but it could be a pretty generous retirement contribution. But as a self-employed individual, like Rachelle said, you've got the control. If you have the cash flow and the earnings to do it, you can put six figures away pre-tax for retirement if desired. Um,
Hmm.
it's we got to structure the retirement plans accordingly. It's not just I'm going to throw 100,000 this year into my retirement. It's not quite that straightforward and simple. But you have a lot more control over the types of plans being offered, how much gets contributed to them, and whatnot.
Yeah. We're focused a lot today on like how to reduce your taxable income right now, but that's not the only consideration. So depending on your tax bracket and things like that, it may make sense to consider some Roth contributions, which don't reduce your taxable income now, but that money can be invested and it can grow. And then, when you take it out in retirement, you don't pay taxes on the distributions at that time. So just because we're talking about pre-tax contributions and emphasizing pre-tax contributions right now, like make sure you're considering all the options that are available to you. And it may be that tax savings later is more important to you than tax savings now. And you get to decide that depending on what your tax bracket is and all those kinds of things. But yeah, I think like all of these things are important just for tax planning in general. The one, not one other account, but one other account that you can potentially access is like a health savings account. So if you are enrolled in a high deductible health plan, you potentially have access to a health savings account, which you can also put money into pre-tax and use potentially for medical expenses or invest and use later in life for medical expenses. It can even be used like a pre-tax retirement account after age 65. So like distributions will be taxable, but there's no penalty taxes. So that can be another way to reduce your taxable income. It's not a lot of money. It's like, I think it's like
Like
8,550,
8,700 this
8,700,
year,
something like
maybe.
that for a family.
Yeah.
Like, and if
Yeah.
you're an
Better than nothing.
individual, yeah, exactly. So that's all money that if you do put it in there, you don't have to pay taxes on it this year, which is great. So there's another
And
chunk of money you can
can
potentially
withdraw
set
it
aside.
tax free for medical expenses, which
Right.
also great.
Out, very great.
It's the
Yep.
only account that you get a tax deduction on the front end and don't pay taxes when you take it out.
Yeah.
It's truly tax free.
There are other like potentially more complicated things that people sometimes do. Like if you get involved in real estate, like rental properties and things like that, you maybe have like depreciation that can offset income and other more complicated things. So that's definitely something to chat about with an accountant. Sometimes when you do things like that, you're really just kicking like taxes down the road. You're not necessarily like insulating yourself from taxes, but that's the same thing with pre-tax retirement plan contributions. Like we're not protecting yourself from taxes forever. You're just reducing your taxable income now, knowing that when you take that money out later, you're going to pay taxes on it at that time.
I think the two
But
arguments in favor of real estate or that, real estate
mhm.
investors are keen on is like you can deduct a lot of expenses associated with the property and that depreciation to offset the revenue generated to essentially not have to pay much tax on it unless you're generating a ton of cash flow relative to the expenses and that depreciation you offset the income and then you're essentially paying it back via capital gains taxes later on when you go to sell the property. But if you hold the property till death, your heirs get to step up in basis and don't have to pay any taxes on profits when they sell. So, like, yes, all else being equal, it can be a little bit more of a beneficial investment from a tax standpoint. But is it worth the headache? Up to you, you know? It depends on the property. Some properties might be low maintenance, great tenants, and you just get your money and everything's golden. But I've heard probably more horror stories than success stories from individuals. Granted, people like to complain about things rather than saying, "Oh, my rental property is going great. I get my rent every month and I've never had any issues." Like that's not a cool story. But my tenants are squatting, haven't paid rent in 3 months. They broke this thing and won't pay. Blah blah blah. So, um, but
Yeah.
anyways, the other thing that we've been asked about in recent years since it was introduced is the ability with accelerated depreciation on your real estate property. You can use that to deduct your W-2 earnings, which is normally not the case with rental income. Like your expenses associated with real estate, you can't offset your normal day job earnings. You can just offset your income
Passive
from
income versus
the
real
passive
income.
income.
Yeah.
But with
Yeah.
accelerated depreciation, I think was it reduced to 40% this year? I forget what it is. But you can
Mm.
depreciate a good chunk of the property in year one and offset that from your day job, which sounds great, but it's only that first year that you get that perk. And then it's less depreciation in future years because you accelerated a good chunk of it. So it's going to not be as effective in future years from offsetting the rental income. Um, it's not an ongoing tax reducer. It's more of a, hey, we'll give you a little cookie in this first year. And it might be a big cookie depending on how much the property costs, but next year you're back to square one from a tax standpoint. Um, so again, is it worth the headache? I don't know.
Yeah.
Depends how.
This is one of those things like if you're even thinking about it, you should be talking to an accountant first to fully understand how it all works. Because I think like depreciation, like when you write that off and then you have gains that kind of like basically you made that depreciation back. I think that's even a higher tax bracket or than like the capital gains tax. There's like a depreciation recapture tax, which is like 25%, which is way more than. So again, like we're not accountants, we don't know like really exactly the details of how all this works. But if you're considering doing these kinds of things, make sure you're not just using your computer. Like ideally, like maybe you could figure it out. Like obviously you get to make your own decisions about that. But I think working with a professional to make sure you fully understand it before like buying property is probably a good idea.
Yeah, don't solely rely on the Reddit thread for your
Right.
information.
Totally. Yep. Charitable giving is another way that you can potentially, decrease your taxable income depending on, how you do it and all that kind of stuff. Keep in mind that like when you give away money, and you get a tax break for that, your tax break is not going to be more than the money that you gave away. So obviously, like we want to do this because we want to give away that money, not just because we want a tax break. So, thinking about like I want to do some charitable giving, like how do I best structure this to get the best tax breaks and things like that. Yeah, there's some new rules. Yeah.
You can
Oh,
only
you
deduct
talk about
starting
this part.
this year.
Yeah.
Yeah, so they changed the rules
Yeah.
2026 moving forward. If you
Got
itemize,
it.
you're only allowed to deduct charitable contributions in excess of a 0.5% of your income.
Yeah.
So if you're a high incomer, say you're making $1 million a year, well, you can only deduct amounts above $5,000 or
50,000.
$50,000, excuse me. Yeah. Um, no, because
No, am I
50,000
wrong?
would be 5%, right? 100,000 is 10% of a million. 50,000 would be 5%. So 5,000 is a 0.5%
You're right.
because
Oh, a half a
10,000 is,
percent.
yeah. So, if you make 500,000 a year, you got to give away at least 2,500 in order to be able to deduct anything um,
Yeah.
from which,
I think lots of people do.
which is fine. Yeah, maybe you give
Yeah.
20,000 a year away.
Yep.
But it's not fully deductible. Only um, a portion of it's deductible in this case.
Yeah.
Um, and if you don't itemize, now you can actually get a little bit of a deduction. 1,000 a person. You used to not be able to deduct anything for charitable giving if you didn't itemize. So
Hmm.
itemized versus not itemized. Basically, if you have a mortgage of a decent balance and are paying mortgage interest, you're probably itemizing. If you don't have a mortgage, there's a good chance you're not itemizing. Is probably the easiest way to look at it. So you take
Yeah.
the greater of the two. You either take your standard deduction, which I think in 2025 it's 30,000 for a married couple. In 2026 it's what, 32 when change.
Yeah.
It's
It's
indexed to
big.
inflation.
Yeah.
Yeah.
I think even with a mortgage, a lot of people don't
Yeah. So
necessarily
unless
qualify
your
for it.
mortgage interest plus your state and local taxes
Yeah.
plus other things that potentially can be added in there,
Hmm.
um, yeah, you take the greater of the two. So if your itemized number is 40,000, but the standard number is 32, okay, we're going to take the itemized number.
Hmm.
Um,
Yep.
so, but yeah, charitable giving. We did an episode a little while back on this one about the changes with that and how it could make sense to give every other year if you itemize in
Hmm.
larger quantities. So instead of doing 20,000 a year, do 40,000 every other year if that's what you're doing, because then you can deduct a larger percentage of the total amount.
Hmm.
Um, it's not life changing numbers that we're talking about from a tax saving standpoint, but it's tax optimizing. Um,
Yeah.
but let's see. Yeah, we talked about itemizing. Um, the other thing to consider, right now this is early 2026 when we're discussing this. If you're listening in the future, just replace the date to whatever year you're presently living in. Um, Not much you can do for last year. Like 2025 has passed us, year's done. I guess, sure, you could make some prior year contributions to a self-employed 401k, SEP IRA, cash balance plan, or backdoor Roth up until the tax deadline. But aside from that, like you can't deduct additional expenses unless you spent the money already last year. There's not anything else you can do. So now is a good time to start looking ahead to this current calendar year. What are some things you can do now or throughout this year to set you up for success a year from now when your 2026 taxes are coming due? And it's also a good idea, do a mid-year tax review. Connect with your accountant in the summer. Be like, hey, halfway through the year, here's my W-2, here's my 1099 earnings year to date. Here's what I expect to make the rest of the year. Here's what I've done to retirement. Here's my latest pay stub with year to date withholdings. Like, do I need to adjust my W-4 to so there's no surprises come April? Is there anything else I could potentially do that we're not already
Mhm.
doing? My quarterly tax payments, are we still on schedule with that amount? Do I need to increase it? Can I decrease it because my earnings are less than last year? Um, so just the whole idea is avoid any surprises come April and see if there's opportunities to optimize your taxes for the year. Um, and if so, great. We still have 6 months to take care of it. But if we wait until December to take a look, hey, is there anything else I can do this year to wrap things up and make April better? Like, all right, clock's ticking. Your accountant's on vacation because it's December.
Yep.
And I
So is
guess
your
your accountant,
financial advisor probably.
yeah, kids are out of school. We'll maybe check some emails, but there's not a whole lot of, it's not like we can just quickly set up a brand new account on Christmas Eve for you. Um, so yeah, be
Yep.
proactive, get on it
Yep.
earlier. Don't procrastinate.
For sure. I think that's yeah, the story for everyone all the time. But bottom line, as a high income earner, if you are a high income earner, you will pay more in taxes than someone who earns less than you. And they may still be quite simple, but there's also the potential that they become more complicated as you earn more, especially when you're doing things like the backdoor Roth, or if you have sizable funds in a brokerage account and you're dealing with dividends and capital gains each year. If you have any sort of non-traditional investments like real estate and business ownership, that can make taxes more complicated. If you're self-employed, it just becomes even more so on top of everything else. So when they get too complicated to do comfortably, or if you simply don't want to spend the time on it, find someone else to do it. Like, that's it.
We
But
live in a progressive tax system, meaning
yeah,
all else being equal, the more money you make, yes, you'll pay more in taxes than someone who makes less than you, but you'll also pocket more after taxes than someone making less than you, all else being equal. So, like, don't complain to your friends that are making less about how much taxes you pay. They won't like you. You're still coming out ahead at the end of the day. Um, but you're, paying a slightly larger percentage of your overall income towards the tax man. But
yep.
still in your best interest financially to make more money. Because again, even though you'll pay a little bit more in taxes, you'll still make more at the end of the day after taxes. And then, it's always interesting talking to people that are so bent on their taxes and how they can save on taxes. Um, it's I feel like sometimes we get focused on the wrong things. Like optimize your life around personal satisfaction, not around how can I pay as little taxes as possible. Like you might choose to live in California for nice weather and endless entertainment options. Um, Not the best state for tax purposes. But like I think Jensen Huang, Nvidia's CEO, when this whole billionaire tax was proposed in California and a bunch of billionaires were reported buying homes in Florida and Texas and, you know, relocating their personal residence to try and avoid this billionaire tax because it was going to be retroactive to 2025 if it gets approved. When asked his thoughts about it, he's like, I haven't thought about it. I'm, you know, without saying it, he's like, I'm worth over $100 billion. Who cares if I have to pay an extra 5 billion in tax? But it's like, I like it here. I want to stay here. Sure, if I have to pay a little bit more in tax, that's the price you pay to live in California. I'm not moving. I'm not gonna upturn my life, go buy a new mansion in another state, and have to fly back and forth to run my company just to avoid a couple bucks in taxes relative to my net worth. Not worth it. Like, I'm gonna focus on what's important to me and not worry about pinching every possible penny from a tax standpoint. So I think, yeah, obviously do what you can to minimize your taxes, but I don't think, uprooting your life just to save a few bucks in taxes is worth it. Now, that's just my personal opinion. Maybe you have different thoughts. Maybe uprooting your life to save on taxes will satisfy you personally and make you happier.
Maybe there's
Um,
other reasons to make the change on top of the
yeah,
taxes. Hopefully, there's more than one reason for moving across the country.
yeah. And this kind of goes, with just finances in general. Like, oh, I could work these extra shifts and make more money to get to these goals faster and do these things, but at what cost? Like, all right, I'm missing dinner with my family. I'm not seeing my kids today. Not going to be at the soccer game. Like, is that worth it for a few extra bucks? I don't know. Teach their own.
Hmm.
Um, so anyways, uh, I guess other exciting news, we started using this new tax analysis software, where we can like scan our clients' tax returns and it'll give us like the high level summary. Here's what you paid in taxes. Here's what your tax rate was. Here's the deductions you claimed, et cetera, et cetera. And then it gives you like observations and suggestions of, hey, here's some things that you potentially could consider doing that would help you from a tax standpoint. Or, hey, this little section of your tax return doesn't quite make sense. You might want to review that with your CPA and make sure it was done correctly because these numbers don't math. Um, so it's kind of a cool little collaborative strategy to help create some clarity for their tax circumstances and work together with the CPA on tax optimization strategies. So one of the cool perks of technology, there's more stuff out there like that that'll hopefully make your taxes clearer and more efficient, and you have a better understanding of them, and we have a better understanding too, so we can help you minimize your taxes and reach your goals
Hmm.
as efficiently as possible.
Yep. We're right there with you. We don't like filing tax returns either, or personal tax returns. Obviously, we don't do clients' tax returns. But yeah, it's all not the most fun thing, but you'll get through it and you're going to work on your 2026 planning so that taxes are as easy as possible next year. And every year is a new year.
And full disclosure, we're not tax experts. This isn't tax advice. This is
Mm-mm.
entertainment only. Talk with your tax professional for specifics pertaining to your circumstances.
So
Um,
entertaining.
yep, that's what you're listening to us for, the entertainment value. Uh,
Thanks for listening, everyone.
we'll see you next time.